everybody. My name is Bashir Adam, and I'm from the audit firm Nexia SABNT. Today, as part of the EAB CPD program, I'm going to present to you the e-learning portion of, or the e-learning portion of the CPD program known as the Property Tax Update. During the course of this presentation, I'm going to spend very little time just highlighting certain aspects of the 2016-17 budget, more as a refresher than anything else, and then we'll go into a number of topics that I believe would have an impact on you in the property industry. I think to start off with, one needs to understand that there is no such thing as property tax. There are taxes on property and property-related transactions, but there is no such thing as property tax. There's no definition of property tax, but there are a number of taxes that do impact the property industry. So, let's go straight into the budget. What happened? We had the minister having to present a budget on the 24th of February in very adverse circumstances. He needed to assure rating agencies that this country knew what we were doing, that business, public, stakeholders, politicians were all on the same page, and we were going to do whatever it meant and it required us to do to avoid a credit downgrade. He needed to assure the nation that any recession that was looming could be avoided in spite of sluggish growth, unemployment, labor unrest, and other issues that we faced with. And most of all, I think he needed to restore domestic and foreign confidence in the strength and credibility of our fiscal and monetary policies. Now, this is the minister of a nation that for a very, very long time was the powerhouse of Africa in economic terms. So what came out of this budget? Was it enough? Did we avoid the credit did we do enough to avoid the credit downgrade? Some proponents think yes, and others think no. And a careful analysis of the budget speech would point out that we may have fallen slightly short. We didn't really mention a hell of a lot on the state-owned entities, and we know that the state-owned entities are draining the coffers of government, i.e. SAA, Eskom, need I say more. There was no mention of government plans to combat mismanagement despite some cost cutting measures. So while we're cutting costs and we're trimming costs a little bit, all of that may be in vain if we don't cut out corruption and mismanagement of things that we're doing. And there was no mention on the size of the cabinet and the public sector wage bill, and this was something that the pundits widely bandied around in anticipation of the budget speech. It didn't come out as strongly as one would have expected it to. As normal, I'm not going to go through the detail of it, but the public had a lot to say. The public had a lot to say about the fuel levy and its impact on the rest of the economy. The public had a lot to say about sugar tax, and why it's a futility and why it's never going to work. As usual, everyone has a lot to say about the grants that we give to some 18 million South Africans on a monthly basis to ensure their sustainability and livelihood. And of course, there's always a wisecrack in there where someone says, we're paying more on spirits, we're paying more on fizzy drinks, we've got no water to drink, we're in a drought, so what must we drink? So there's a bit of mixed reaction in terms of the budget. I think it was largely supported in the circumstances. It was probably the best that could have been done in the circumstances. So, besides the budget, some of the other topics that we're going to cover today is the Tax Administration Act. And the Tax Administration Act is really, while not a property-specific act, something that impacts businesses, that will impact your business, that will impact the way you do business. Capital gains tax, which is cross-cutting across the property industry. Transfer duty, that you probably know more about than I do, and value-added taxation. So, straight into the budgets then. What did the budget do for us? Or what came out of the budget? There was a 2-year postponement of the annuitization requirement for provident funds and tax-free transfers from pension to provident funds. And if we think about that, what does that mean? In the past, or from a provident fund, you could draw out your entire provident fund when you retired and do what you wanted with it. there was a move to reform it so that you could only draw out a maximum of 1/3 and then have to draw the rest as an annuity on a monthly basis while you were alive and utilize it on that. There's been a postponement of that. So as things currently stand, you can draw out your funds when you retire. The Reserve Bank, in conjunction with the Revenue Services, announced a voluntary disclosure program for offshore assets and income, which is likely to take effect from the 1st of October 2016 to 31 March 2017. That coincides, or it overlaps, the 1st of January 2017, where the OECD guidelines for cooperation come into place. So basically, when that comes into place, different countries would have different impacts or would have different avenues of uncovering offshore assets held in other countries through various cooperation agreements in line with the OECD nations. Capital gains tax, one which impacts every aspect of the property industry. They had the inclusion rate for individual special trusts and insurance policyholders increased from 33 to 40%, i.e. the inclusion, every 40% of every capital gain is included in a taxpayer's gross income for tax purposes. For other taxpayers, companies, trusts, it increases from 66% to 80%. The minister also announced that government is aware of tax avoidance that takes place through trusts, where assets are transferred via loan accounts to be included in the estate of the founder, and where interest-free loans are categorized as donations. On a personal level, I've looked at it. They haven't come out with too much detail on it, so it's a little bit difficult to analyze it. But as it stands in terms of the announcement, the minister was very cryptic in terms of what they're going to do insofar as trusts go. Something else that impacts you on an ongoing basis is that transfer duty rates are increased for all properties in excess of value 10 million rand, where the bracket has gone up from 11% to 13%. The general fuel levy will increase by 30 cents per litre on 6 April 2016. And if you thought that was bad enough, over and above that, the road accident fund levy will increase by an additional 80 cents per litre on 6th April 2016. So those of us that have cars, we're in for a rough ride. And if that weren't enough, if you go down 2 bullets, see that we still have a tyre levy that goes with our tax increases on fuel. And the tyre levy, at the end of the day, is being punted as an environmental tax, a tax that will be used to facilitate recycling of old tires, rubber, etc., in order to bring down the effects on the environment of dumping of these things. Now, we can all think about what that is. Are we really going to pay tax on tires, or are we going to use the tax that comes in from tires for other purposes, i.e. toll roads? As usual, in every budget that I can ever remember, the smokers and the drinkers get punished. It's just the way things work for us, right? So we're going to pay between 6 and 8.5% more for our alcoholic beverages and our tobacco products. And I have never yet once come across somebody who said, I gave up smoking because of the tax that they put on it. So I don't know if it has the desired impact. But the desired impact is never to make us stop smoking. The desired impact is to get money into the revenue fiscus. Finally, the budget is introducing a tax on sugar drinks, sugar-sweetened beverages from the 1st of April 2017. Now, it's being punted as something to promote wellness of the nation, to take away or to assist in curbing obesity. They haven't specifically said whether it's in South African Police Services or in the Defence Force, but it is to curb obesity. That's what they say. What it will be used for, that remains to be seen. Now, ladies and gentlemen, that's in a nutshell what the budget was about. The first piece of legislation we're going to look at in this presentation is the Tax Administration Act. Now, the Tax Administration Act is the act that governs the administration of tax. So you have tax charge acts and tax charge legislations and tax liability legislation, and you have tax administration legislation. It was first punted in 2005, but only came into effect, I think it was in 2010 when the Tax Administration Act came into effect. And it actually deals with responsibilities of the taxpayer and responsibilities of SARS, and how the environment becomes conducive to administering the tax burden of the country. So we're going to look at things like objections, returns, payments, refunds, record keeping, who and where the burden of proofs lie, disputes and penalties. As previously mentioned, tax legislation generally comprises of two aspects of tax. One is tax liability provisions, and the other is tax administration provisions. Tax liability provisions are those provisions that deal with what's the tax we're going to pay, who's going to pay the tax, how the tax is going to be paid. Tax administration provisions is the environment within which, it governs the environment within which tax liabilities need to be paid, tax charges are determined, and how these things are determined. The Tax Administration Act came into effect on 1 October 2012. It brings into place one piece of legislation that governs all aspects of taxes. So it pulls it all together and says to deal with capital gains tax, income tax, donations tax, estate duty, VAT, from an administration perspective, this is how it works. And what does it deal with? It deals with things like objections and refunds and what do we need to do. So if we look at objections, for example, Section 104 of the Act states that a taxpayer may object to a tax assessment if he or she has been aggrieved. So in terms of the Act, it's not only SARS that has rights, we have rights too. We have rights to object to an assessment where we feel we've been aggrieved. Whether SARS feels we've been aggrieved or not, that's another story, but we have a right to object, and whether our objection is listened to, that's another story, and that gets covered throughout the Act. So what can we object to? We can object to a decision not to extend the period for lodging an objection. So in terms of the Act, we've got to lodge an objection in X amount of time. If we want to extend that, that period, we need to apply for it. If SARS turns it down, we can object to them turning it down. A decision under Section 172 not to extend the period of lodging an appeal. So if we've objected to something and they've turned down our objection, we have a right to appeal against it. And that appeal must happen in a specific time frame. If the appeal doesn't happen in that time frame and we need an extension for it, we can request it. If they turn down an extension, we can appeal against that as well, or we can object against that as well. Any other decision may be objected to or appealed against under a tax act. So anything that SARS does gives you the right to appeal to it. What it doesn't do is give you the right to withhold payment of taxes that are due. So you still got to pay the tax, even if you're objecting, even if you're appealing. We call it the pay now, argue later principle. SARS takes your money now, you can fight later. It's as simple as that. There's no long stories about it. There's no issues about it. That's the way it is. Objections and appeals must be completed per the rules set out for lodging by the Minister of Finance. So whenever they come out with a guide or they update the Tax Administration Act, there's certain rules. It must be done within X amount of days. It must be on a prescribed form. It must be to the right office, etc., etc. You've got to object or appeal in accordance with those criteria. If you don't do it in accordance with that criteria, that objection is not valid. And you've got no leg to stand on because they say you can do it, but this is the way to do it. All right? Tax returns. Any person who submits a tax return must do so in the prescribed form or manner. So in the first place, all tax forms are published by SARS. You've got to do it on there. Now, many of you are going to put your hands up and say, what about e-filing? E-filing is a form. It's a form. It's an electronic form, and it's a prescribed and permitted form by SARS, but it is a form, right? The dates on when returns should be submitted are set in terms of a particular act. So those of you that deal with pay-as-you-earn will know that by the 7th of the month, for your pay-as-you-earn return relating to the previous month must be submitted. Those of you that deal with VAT will know that on the 25th of the month, your VAT return must be submitted unless you're on e-filing where you can do it to the last day of the month. Any form or any return, any tax return, a VAT return, a pay-as-you-earn return, an income tax return, a capital gains tax return, a dividends tax return, any one of those returns must be signed by the taxpayer. You have to sign it because you take responsibility for the contents that is on that return. The fact that a person does not receive the return does not affect the obligation to submit and render the return. So if the post office is on strike and you didn't get your form, you can't say, I didn't get the form, that's why I didn't submit. You need to submit. How does payments work? A taxpayer is personally liable for the tax which he or she owes, right? So if I'm a taxpayer, I can't blame my liability on my mother or my father or anybody else. If I need to pay the tax, it is my responsibility and I am liable to it. And not paying the taxes due in South Africa and around the world indeed is a criminal offense. So if you don't pay the taxes, it's criminal. It's as simple as that. A person's obligation to pay tax is not automatically suspended by an objection or appeal. Remember what I said earlier? We pay now and we argue later, right? So the fact that we are appealing or objecting does not mean that our tax, the tax payable is suspended. Now, what is a taxpayer? Who is a taxpayer? Any person that must pay tax is a taxpayer. A representative taxpayer, what would be a representative taxpayer? Example, the executive of an estate. He's a representative taxpayer. A trustee of a trust. A director in a company. A withholding agent. A withholding agent is an employer. They're required to withhold pay as you earn and pay that over to SARS. A responsible third party. What would be a responsible third party? A responsible third party in the context of this would be somebody like a company who declares dividends, because that company has to withhold, as a third party, withhold the dividends tax on behalf of the taxpayer and pay that over to SARS. Right? A person who is the subject of a request to provide assistance under an international agreement. So if Scotland Yard phones SARS and says, listen, we want to cooperate, and I almost used the word about the Czech fugitive that we've got somewhere, and I just realized maybe I mentioned the wrong name. So under an international agreement, that person would be regarded as a taxpayer for the purpose of the Tax Administration Act. Any person is entitled to a refund from SARS if an amount is properly refundable under a tax act in an assessment. So if in terms of VAT you're entitled to a refund, you're entitled to the refund. Or the amount is erroneously paid in respect of an assessment in excess of the amount payable. So for example, let's say your tax liability is 1,200 Rand, and when you paid it, you paid 12,000 Rand. You put an additional 0 on it. In that case, you're entitled to a refund from SARS. SARS may, not must, not will, may audit a refund, but the refund can be made notwithstanding the audit. So they can make the refund and say it's subject to an audit. They, generally speaking, in practice, do not do that. They will not give you your refund until they are satisfied that that refund has been audited and is ready to go. The refund must be authorized before it's paid. I mean, that goes without reason. The refund has to be claimed. So if SARS assessed you for something and they determine that you have a refund, you must claim it within 3 years. If you put in a self-assessment and you realize through the self-assessment process that you due a refund, you must claim that within 5 years. So very simple. If SARS determines it within 3 years, if you determine it within 5 years. They may also set refunds off against other taxes owing by the taxpayer. So let's say you owe them VAT of R1 million, right? And they owe you income tax of 200,000 Rand. They can set off that 200,000 Rand against the outstanding VAT. You can't go to them and say, I want my 200,000 Rand. They'll say to you, and the $1 million on that side, what's happening with it? The Tax Administration Act goes a lot further in determining what record keeping is. And I think, ladies and gentlemen, this is important in the way we deal with stuff. For those of you that attended the inspections presentation that I did last year, we spoke about maintaining records from an inspection perspective, or maintaining records from a FICA perspective. Now we're talking about it from a SARS perspective. So what does SARS say? SARS says a person must keep records, books or accounts of documents that enable the person to observe the requirements of the Act. So one, while they don't tell you it must be on computer, they don't tell you it must be paper-driven, they don't tell you must keep it on papyrus, they don't tell you must keep it in hieroglyphics or which language, they don't prescribe. But they must say you must observe the requirements of the Tax Act. So that's what your records must do. Are specifically required under the Tax Act. So where the documents, where the Tax Act, the VAT Act, for example, tells you you must maintain all invoices that you keep for a period of 5 years, and those invoices must contain all the following details. When they specifically say that, you must keep those invoices. Your records must be able to enable SARS to be satisfied that the person has observed these requirements. So if someone walks in and says, can I see your records? And you can take them to a filing cabinet and show them this filing cabinet and says, well, there's all my invoices, creditors' invoices, there's all my customers' invoices, there's all my, in the case of estate agents, my lease contracts, there's all my offers to purchase, etc., or deeds of sale. And you put all of that in there. SARS, reasonably speaking, can say you're keeping records in accordance with the Act. Records must be kept for a minimum of 5 years, and they must be kept in the original form or as specified by SARS. Now, I must tell you, when you take this and you couple it with the Electronic Communications Act and all of those nice things, you can keep these things electronically. So you can save records electronically, etc., except for third-party records. Third-party records that are given to you in hard copy must be maintained as such. The records must be available at all times to SARS for inspection. An inspection which they can make on an unannounced basis. Now, ladies and gentlemen, doesn't that sound familiar? We know someone else who can make inspections on an unannounced basis. All right? The EAB, right? And the FIC. So everybody can make inspections on an unannounced basis. By the time every regulatory agency inspects you that's entitled to inspect you, you've got no time to run your business. Okay, the burden of proof. The taxpayer bears the onus of showing that an amount is not taxable. So the taxpayer, if you think you shouldn't be taxed on something, you have the burden of proof to do it. The only onus resting with SARS is to show that the amount of an estimate is reasonable. So SARS, where, for example, you have not put in a tax return, SARS can estimate what the tax is that you would have paid had you put in the tax return. Right? In a case like that, it is up to SARS to prove. They have the onus to say the estimate is reasonable. Right? They must, not you must prove that it's unreasonable, they must prove that it's reasonable. The taxpayer must show in a tax court that the tax treatment was incorrect. So, where you disagree with what SARS did, the onus is on you to prove in court that SARS did the wrong thing in this particular instance. Disputes. There's two types of disputes encountered in the Act. Disagreements on the interpretation of law. In such disputes, the normal dispute resolution steps are followed. So you go through objection and appeal, alternative dispute resolution, appeal to the tax board and the tax court, and further appeals to higher court. So you can take a tax matter all the way to the Supreme Court of South Africa, and even to the Constitutional Court if you believe that it's not constitutional. And someone did it with the Reserve Bank. Mark Shuttleworth. Mark Shuttleworth, the billionaire that sold his little internet company for hundreds of billions, he took the Reserve Bank, and the Reserve Bank actually found in his favor in terms of, not the High Court, the Supreme Court of Appeal found in his favor, or the Constitutional Court found in his favor, and he didn't have to pay the penalties, etc., that the Reserve Bank were claiming from him. The disagreements on procedural administration of law. So complaints in this regard must be reported to the tax ombudsman. So where you believe SARS is victimizing you and they're not accommodating you in terms of the Act, in terms of the time frames, in terms of all of those, and they're not giving you a fair hearing. That's procedural, that's administration. That's where we talk to the tax ombudsman, who I believe has so far been very fair on everything that he's adjudicated on. penalties. Ladies and gentlemen, we have, and our penalty regime with regard to taxes in South Africa has been getting more and more harsh. But we're still nowhere near where the developed world is, the likes of the UK and the US, in terms of enforcement of these penalties. And that's the part. If we can enforce it, then I think there's going to be a lot of people or not so happy taxpayers that are out there. But I think the principle is very simple. The principle is where the cost of doing or not doing something outweighs the benefit thereof, it will serve as a deterrent from the person of doing for doing it. So that's what penalties are based on. We want people to comply. So therefore, if they don't comply, we'll penalize them, which pushes them towards compliance. And I think that's what it comes down to at the end of the day. So the two types of penalties is administrative non-compliance penalties, i.e. I was supposed to put in a return on the 31st of January and I didn't put in the return. That's non-compliance. There's a penalty attached to that. An understatement due to a serious non-compliance penalty. Administrative non-compliance is failing to keep records, not submitting returns, etc., etc. And the way that is calculated is there's a fixed amount penalty. So for every month that I put in my tax return rate, I get a penalty of 250 Rand that increases on a monthly basis, or a percentage-based penalty. So if I was supposed to pay tax of 100,000 Rand and I didn't pay 100,000 Rand on due date, there may be a 10% penalty that gets added to that amount. So now I've got to pay 110,000 Rand. So that's really what that comes down to. We go into capital gains tax. Capital gains tax is probably one of the components of income tax that affects the property industry more than any other. More than any other. And it's the common acronym for it is CGT. It was introduced into the South African Income Tax Act on 1 October 2001. Prior to that, we didn't know about capital gains. Capital gains, anything that was capital gain was non-taxable, never fell in gross income, and that's what it came down to. Capital gain tax applies to all sales of capital assets, in this case, or in your cases, property, or on or after the 1st of October 2001. The calculation of a capital gain is defined in the 8th schedule of the income tax. So what is capital gains? The basic concept is that if a capital item is sold at a profit, then the profit amount is subject to a certain tax, in this case capital gains tax. Who is liable for capital gains tax? Residents of South Africa. CGT is applicable to any capital asset of a South African resident that is owned anywhere in the world. So if a South African resident owns property in Mauritius and he sells that property, that capital gain is taxable in South Africa. For non-residents, now non-residents refer to people who are not resident of South Africa, and because South Africa works on a residence-based tax regime, if they're non-resident, they're not taxed in South Africa. It's as simple as that. However, from a CGT perspective, where a non-resident has property in South Africa or right to any property in South Africa, the disposal of that property will result in a gain being taxed in South Africa. So even if you're not tax resident in South Africa, you can still be taxed on any capital gains that you make in South Africa. So the capital gain framework, how do we calculate it? A capital gain or capital loss is equal to the proceeds from the sale of the capital asset. Now, let's just use an example. We're selling an asset for R1 million, less the base cost of an asset. Now, let's say the base cost, my cost of the asset is 500,000 Rand. So we've got a capital gain of 500,000 Rand. That capital gain is 500,000 multiplied by the rate of inclusion. Right? How do we include that in our capital gains? The 500,000 Rand, if the rate of inclusion in the case of companies is 80%, 400,000 gets added to our taxable income and is taxed at 28% if we were a company. Okay. CGT is triggered by a disposal of an asset, and that one is in red. And the reason it's in red you do not have to sell an asset to trigger CGT. You just merely have to dispose of it. You can abandon it, you can donate it, you can lose it when you die. All of those things are tantamount to a disposal of an asset. So capital gain or loss is the difference between the proceeds and the base cost, including all costs incurred in acquiring and improving the asset. Now, let's take the nice case of PRASA, the passenger rail company of the country. They bought a number of locomotives from Spain. Are those capital assets? Yes, they're capital assets. Right? There's no question about the fact that they're capital assets. When they bring them in here, they find that they got the wrong spec of locomotive. So these things can't go through the tunnels, and they can't fit on our rails and all of those nice things. And all of a sudden we're sitting with 50 of these things at a cost of many billions. But we can't use them. So what do? We alienate them. We tell government we need more money, and government gives us 13.5 billion rand in the budget, and we use this to buy new locomotives. And we scrap the old ones. So we just leave them there, let them just get rotten. That is a deemed disposal. But the cost of getting that asset here will all be included in the base cost of the asset. So the base cost of the assets, how do we get to them? For assets acquired before October 2001, the value is determined at 1 October 2001, plus expenditure after that date. So where we've got a valuation on that date, that's the value that we use, plus any expenditure on the asset after that date. So if on the 1st of October 2001, you had a house that you bought in 1990, or 1991, let's use round figures, for 100,000 rand, and you have that asset valued at 2001 at 1 million rand. For CGT purposes, your base cost is 1 million rand. If you keep that asset for another 10 years to 2011, but in that time you built a pool and you put in a jacuzzi and a sauna and you increase that and you spent an additional 1 million on it, your base cost at the time of sale will be 1 million, being your valuation at 1 October 2001, plus the additional 1 million that you've spent after 1 October 2001. So your base cost will be 2 million. If it was acquired after October 2001, it's the actual costs incurred in acquiring or creating the asset. Right? So that's easy. There's no application there. That's the cost of the asset. The base cost is reduced by amounts included in normal tax. So where you've got repairs and maintenance and you claim the deduction on repairs and maintenance, you can't add that to the base cost of the asset. Right? All gains and losses are calculated, and the net amount is included in the income of the taxpayer at the inclusion rate. In the case of companies, the rate is 28%. CGT allows certain exemptions to individuals. The first one, and probably the most important individual, is the primary residence exemption. Right? Primary resident exemption applies to a natural person and to special trusts. If the primary residence is disposed of by a resident, the first 2 million of profit, so the first 2 million capital gain, is excluded. You don't add that to income. So if it's your primary residence, you don't add it to income. Interestingly enough, for it to be your primary residence, you must own it. You, not a company, not a trust, you personally need to own it. So can you imagine what happened in 2001 and 2 when all those people had trusts and companies and all of those nice things, and CGT came in? Everybody went to dismantle the trusts and transfer properties out of the trusts, etc., etc. So that first 2 million is excluded. And it must be your primary residence. Question. Let's think about it. I live on a boathouse on the Vaal River, and I sell the boathouse. Is that my primary residence? And do I get the exemption? The answer is yes. The boathouse, I live there. It's my primary residence. So if I sell it, I do get the exemption from there. In certain instances, we must apportion the exemption, and we'll do an example of that one now. Mrs. Y purchased a primary residence on 1st of March 2009 for 1.2 million rand. So, when did she purchase? After October 2001. So, the base cost is 1.2 million rand. She started to use 30% of the floor area of her home for business with effect from 1 June 2012. Right? So that's when she started using it. So she had the house for, 10, 11, 12. She had the house for 2.5 years before she started using it. On the 29th of February 2016, she sold the house for 3.3 million rand. Calculate her capital gain. Right? Very simple. In the simplest of scenarios, the capital gain is the difference between the selling price, is 3.3 million, and the base cost of 1.2 million. Agreed? So we have 2.1 million as our capital gain. We do, however, have to take account of the fact that 30% of it is business purposes. So what if it's business purposes? If it's business purposes, it's not all her primary residence. So we've got to take account of that. So when we do it, we had the first part right. 3.3 million is the selling price. The base cost is 1.2 million. The capital gain is 2.1 million. The portion attributable to business purposes of the 2.1 million is 337,500. Now, how do we get to the 337,500? It's 3.75 years of the total times 30% of the gain. So if we take 2.1 million times 30% gives you 650,000. And if you work out the number of months, it gives you 3.75 years, gives you 337,500. So from a capital gain perspective, the primary residence capital gain is 1.7 million, not 2.1 million. So that's the first thing we've got to get right. Then, if our capital gain is 1.7 million, then we can't have a primary residence exclusion of 2.1 million. It's got to be limited to the gain, right? So, and then we have the capital gain on the business portion that we bring into it. And then there's an annual exclusion that natural persons get. That amount, incidentally, has gone up to 40,000 in the new budget. And the net capital gain will be 307,500 as opposed to 2.1 million that that Mrs. Y needs to include in a taxable income. So from a capital gains tax perspective, when must CGT be paid? It must be paid when tax is paid. It's very simple. If you pay provisional taxes, you must estimate your capital gains and must pay in your provisional taxes. Otherwise, on assessment when you are required to pay your tax. Ladies and gentlemen, now we deal with transfer duty. Transfer duty is probably more familiar to you than it is to me. It's something you come across on an ongoing basis, but we're going to look at some of the tricks and the intricacies of transfer duty in the course of the next 15 or 20 minutes. So what is transfer duty? Transfer duty is an indirect tax. So it's not a direct tax like income tax. It's indirect tax paid on the acquisition of fixed property situated in South Africa. So what do we need? There needs to be an acquisition, it needs to be fixed property, and it must be in South Africa for transfer duty to happen. The Transfer Duty Act imposes a transfer duty on the value, not the price, the value of any property acquired by any person by way of a transaction or in any other manner. So what do we need? We need property with value. It must be acquired by any person by way of a transaction. This is also applicable where the value of any fixed property is enhanced. Right? So where value of fixed property is enhanced because another person has renounced their interest in the property, another person renounces their interest or restriction upon the use of that property, so somebody benefits. That's what it comes down to. Somebody must benefit as a result of a decision taken by somebody else. So what does property mean? Property in the context of transfer duty means land in the Republic of South Africa and any fixtures thereon, and includes any real right in land, but excluding any right under a mortgage, bond, or lease. So any real right that we have, so an option in a property, anything like that, except for a mortgage bond or a lease on a property. Any right to minerals in a property and a lease or sublease of such rights. So it includes any right to minerals. A share or member's interest in a residential property company, so where a company owns residential property, that share or member's interest in that company is deemed to be property. A share or member's interest in a holding company, closed corporation, if that entity and all its subsidiary entities would be a residential property if they were a single property. So if they were all together, they'd be one. A contingent right to any residential property or member's interest held by a discretionary trust. So a contingent right is if something happens, so it's a contingent upon the outcome of something, then you will get something. So for example, if someone dies, the property will become mine. That gets defined as property in terms of the definitions. And then any share in a share block company is also defined as property. For those of you who are unsure, a share block company is something that used to be very common a few years ago, particularly down in KZN. And really what it is owning a share in a company that gives you the right to occupation or use of a property or a property owned by that company. All right? The transaction you can go through, I'm not going to go through the detail of what the transaction means. Acquisition. For transfer duty to be payable, there must be property acquired. There is no definition of acquire in the Act. The Act doesn't, it tells you property must be acquired, but it doesn't define acquired. Court cases have given some guidance on the matter. The general rule is that it involves the acquisition of rights. So you don't have to have ownership, but rights. So right to use, right to live in, right to sell, right to acquire. So you must acquire rights to receive the transfer of immovable property. So at some point, that right must give you the ability to transfer immovable property by way of a transaction in terms of an agreement of purchase and sale. So as long as you've got those elements, so a right, a transaction, agreement of purchase and sale, you have the acquisition that's included in there. For the purpose of transfer duty, the date of acquisition is very important, because the date of acquisition, as we've just seen, transfer duty on properties of 10 million and more has gone up from 11% to 13%. So the date is important because the date could determine whether you're going to pay the transfer duty at 10%, at 11%, or at 13%. So we need to look at the date of acquisition and what defines it. In the case of the acquisition of property, other than the acquisition of property contemplated in paragraph B, the date on which the transaction was entered into, irrespective of whether the transaction was conditional or not. Now, you estate agents will know, conditional or not, I'm buying this house subject to the bond. I'm buying this house subject to me selling my old house. All of those conditions come into these transactions that you guys facilitate with your buyers and sellers. Irrespective of whether the transaction was conditional or not, or was entered into on behalf of a company already registered or still to be registered, in the case of the acquisition of property otherwise than by way of a transaction, the date upon which the person who so acquired the property become entitled thereto. So what's the date of acquisition? The date of acquisition is the date on which the transaction was entered into, i.e. there was an offer and acceptance. That is the date on which the transaction was entered into. A person, I'm not going to go through the definitions of person, but it talks about any person. And any person talks about corporate and juristic people as well as natural people. Value, and remember earlier I said value refers to the value of the property, not necessarily the price of the property. The value is the greater of the consideration payable of the property, the declared value where there is no consideration, or the fair value property as determined. So SARS could ask for the fair value of the property for the purposes of transfer duty. The term fair market value is defined in the Act and is essentially the fair market value of the property. So they're telling you that the fair value is the market value that you can get for the property. Transfer duty is payable by the purchaser. So generally speaking, transfer duty is payable by the purchaser and has to be paid within 6 months of the date of acquisition. The date of acquisition is the date the transaction was entered into. It must be paid within 6 months, and the two tables set out the rates of transfer duty that are applicable. And we notice that from the 2016 table, the highest bracket was for properties of 2.2 million and above. We paid 85,000 plus 11%. In 2017, a new bracket was added for properties 10 million and above, where we now pay 13% of transfer duty on those properties. All right, by way of a case study, if you purchase a flat in Hoodstock for 1.15 million, what would be the transfer duty? Right? We go back to the tables and we work that out, and we're going to get to the solution now. The second one is we purchase a large family house in Claremont for 4.4 million. And again, the solutions are as follows. If you purchase a flat in Hoodstock, for the first 750,000, we pay no transfer duty. So there's zero. The next 350,000 rand of the purchase price, we pay 3%. That amounts to 3% of 350,000. That's 10,500. That is the transfer duty payable on buying the property in Hoodstock for 1.15 million. If we purchase the larger family house in Claremont for 4.4 million, we look at the amount per the tables. And the band that will apply is that band. 4.4 million falls into that band. So the first amount is 85,000, and that's there. And the second amount, the amount above 2.25 million, would be transfer duty would be payable at 11%. So that gives us 236,500 and a total of 321,500 of transfer duty that's payable on that property. If we look at transfer duty penalties, those penalties that would apply in the case of transfer duty. If the transfer duty is not paid within the period allowed, a penalty and interest will be payable in addition to the unpaid transfer duty. The penalty is calculated on the duty at 10% per year for each completed month. So for every month, there's 10% as worked out annually that we pay. That amount is interesting to notice has not changed since 1982. It's been a 10% penalty that we've got on that particular one. The last area that we're going to look at today is value-added taxation and how this impacts the property industry and the property markets, particularly on the transfers of properties. Some of the issues that we need to look at is when do we pay VAT as opposed to paying transfer duty? What are the VAT rules where a seller and a purchaser are not registered for VAT purposes? What are the VAT rules where a seller is not registered for VAT but a purchaser is registered for VAT? What are the rules where a seller is registered but the purchaser is not registered? What are the rules for zero-rated transactions and where both parties are registered for VAT purposes? And what are the rules regarding the sale of share block and loan account in a share block company? I'm not going to spend much time on the share block company because I don't think it's relevant in the property industry as much as it was prevalent many years ago. Transfer duty is defined as a tax levied to know whether we pay transfer duty or we pay VAT. We need to understand the difference between transfer duty and VAT. Transfer duty is a tax levied on the value, again we say value, not the price, of immovable property acquired by any person by way of a transaction or in any other way. Right? So that's the first thing we need to understand. That's on the value of a property. VAT is an indirect tax on the consumption of goods and services in the economy. Fixed property is defined in the VAT Act as land, sectional title unit, share in a share block company, and any time sharing interest. Now, if you're going to look at fixed property in the VAT Act and you look at land or property as defined in the Transfer Duty Act, they overlap. They overlap quite significantly. So, and then you go one step further, and in the VAT Act says the definition of goods in the VAT Act includes fixed property and any real right in fixed property. So there is an overlap between the two acts, and if we were to apply both acts to certain transactions, we would end up breaching the basic premise of tax, that we don't tax the same transaction twice. Value-added tax is a tax on the value added by each vendor on the production chain and is imposed each time a taxable supply of goods or services takes place. So value-added tax as a product goes on from producer, manufacturer, processor, until the last consumer, there is VAT payable in the chain of supply. Each vendor who is in the VAT Act is required to account for VAT on the value added by that vendor. So what does that vendor do? He claims the input credit on what he buys, and he pays the output credit on what he sells, the output tax on what he sells. And the difference between the two should be the VAT percentage on his profit. A vendor is required to account for output tax on any taxable supplies, but is also entitled to deduct from accounting any input tax incurred by the vendor. VAT is calculated at a flat rate of 14%, whereas transfer duty is levied on a sliding scale ranging from 3% up to, it's not 11% anymore, it's now 13%, given where the budget speech went to. Interestingly enough, in this year's budget, everyone thought that VAT was going to be put up as one of the sources for revenue for government. It didn't, so we touch wood, it stays there for now. So let's look at some examples of how it works. VAT rules where the seller and the purchaser is not VAT registered. A sale by a non-vendor to a non-vendor. Remember, a vendor would be someone VAT registered. A non-vendor is someone not VAT registered. So if you are a non-vendor and you purchase a flat in Woodstock from another non-vendor in their personal capacity for 1.1 million, what works? Exactly the same discussion we had just now. There's no VAT payable because nobody's a vendor, and if there's no vendors, there's no VAT that's payable on the transaction. Where the seller is not registered for VAT, but the purchaser is registered for VAT. So a sale by a non-vendor to a vendor, no VAT is payable, but the purchaser will be liable for the payment of transfer duty. So you can't pay VAT because the seller is not VAT registered. So seller can't charge you VAT. So the purchaser pays the transfer duty. Fixed properties are classed as second-hand goods, and the purchaser is entitled to claim a notional input VAT on the purchase price of the property. If the purchaser has acquired a share in a share block and link loan company, then the deemed input tax credit will again be claimable by the purchaser, and the purchaser who is entitled to claim deemed input cannot claim it until such time that the output tax or the transfer duty in this particular case has been paid. Where the seller is VAT registered but the purchaser is not VAT registered. Now let's just look at it. Where seller is VAT registered, that seller has got to charge VAT, right? The purchaser is not VAT registered, so he can't charge VAT. Well, that's what logic tells us. Sell by a non-vendor, by a vendor to a non-vendor. So the same flat we're talking about is now being bought for 1.15 million. The seller charges the 14% because the seller is the vendor, right? So he's got to charge the 14%, but the purchaser is not entitled to claim an input tax credit because he is not registered for VAT purposes. No transfer duty is payable on that particular transaction because we're already paying VAT on the transaction up there, and the purchaser is the end user, and he's got to pay that VAT to the seller. So imagine if the purchaser had to pay the seller the VAT and he had to pay the transfer duty on it. Just doesn't make sense. So, ladies and gentlemen, if we look at VAT and transfer duty, we can be confronted with any number of options and combinations, and all of them have different rules. Every one of them needs to be looked at their own merit, and you decide from there what's the best treatment for it. From a VAT perspective, remember when I spoke about CTT, we spoke about change of use and disposals and all of those things. Where a developer who lets residential property prior to sale is granted relief from the VAT change in use rules, because In the old days, prior to the 10th January 2012 amendment, where a developer has claimed input VAT in the course of building a development, but did not sell the property, so he's not paying the output VAT, but he got the benefit of the input VAT, what would happen? He would be deemed to have disposed or changed use of that property and would have to pay the output VAT on it. From 2012, they've given him a dispensation that where he cannot sell the units that he's built, but he has maintained those units and kept letting them out in the hope of selling them, that he's got 36 months per unit. If he's unable to sell due to a lack of demand or not being able to get his prices, what does he need to do? He needs to prove that he is marketing to sell, that he is an active seller, because that concession falls away on the 1st of January 2018. The general rule in general purchasing a property is subject to transfer duty, which is payable on the property, unless the seller is VAT registered. Where the seller is VAT registered, the transfer duty is not payable. Ladies and gentlemen, thank you very, very much. Again, my name is Bashir Adam. I come from an audit firm called Nexia SABNT. So if there's anything that you do require from us in terms of assistance, please feel free to contact me. I want to take this opportunity to remind you to please complete the quiz and the multiple choice sessions, multiple choice questions at the end of the session, in order that you can get the 6 CPD points for which you qualify. Thank you very much.